What is going on? We are back with a risk management video for the bootcamp, and this is the last video before I finally get into what you should actually be trading with, how you should be trading, and how the market really moves. So the reason why I'm doing this video before any of that is because you will not understand that you cannot be profitable if you do not understand this video. Risk management is everything, and you need to understand how risk management works to be profitable. So if you don't underuse TradingView, which you should already be using, there's basically something called a long position tool and a short position tool. And this is what you should do to calculate your risk. So let's say I want to take a short here. Okay. You just click that, you draw this, and basically this line is the entry. This is going to be the stop loss. This is going to be the take profit. And I'm using an EMA to show the risk management what I want to try to do. And like I said in the previous video before, I could go back to using indicators and be profitable because of risk management. So let's say I want to take a short position because we closed under this EMA, and I think, oh, because we closed under the EMA, we're going to go down. So what I want to do is I want to take a short entry when we tap the EMA again. Now, typically for most stop losses for anything you take, your stop should be above the high or low. So the swing high or swing low. Don't get it confused with this high. This is not a swing high right here because there's a lower high, lower high, lower high. This is a swing high because it's a lower high, higher high, and then a lower high. It's just like that 3-candle formation. So don't get confused with that. So your stop loss should be above the most recent swing high, which would be here. So let's say I want to take a short here, and this is going to be the entry. And let's say I want to target a 1-to-1 R, meaning the stop loss size is the same as the take profit size. Now, if you're going to take a 1-to-1 trade, you need to see this diagram. And this is the most important diagram you will ever look at regarding risk management. I know it seems a little daunting at first, but let me show you how to read it. So basically, this is called risk to reward versus the win rate, meaning it tells you if you have a so-and-so win rate, it tells you what risk to reward you need to be profitable. So basically, starting off, if you have a 50% win rate, you need at least a 1-to-1 risk to reward to be break even. Okay? So here's a 1-to-1 risk reward. This is what is drawn on the chart right now. This is a 1-to-1. So to be break even, you need a 50% win rate at a 1-to-1. Okay. Now, if you want to be profitable, okay, keyword profitable, taking 1-to-1 R trades, you need a 60% win rate, 70% win rate, 80% win rate, or a 90% win rate to be profitable. Okay. So do you see how that works? So again, you can see for a 9-to-1 R trade, you need to have a 90% win rate to be profitable. Okay, if this means if you have any lower, then you're not going to be profitable. Now for a 1-to-9, meaning something like this a 1-to-9 would be something like this. You need at least a 10% win rate to be possible or profitable. Now, this is very hard to do. And you're probably wondering, well, why wouldn't you just do this and try 10 attempts? It's just very hard. I would not recommend this. But basically, it's pointing out that you need to be profitable, you need at least a 20% win rate, okay, for a 9R play. So I'm going to start with just going over 1-to-1 and 2-to-1 R. So here's 1-to-1, here's 2-to-1. And I don't really like, I wish these numbers were switched around. This should be the opposite. But here's 1R and here's 2R. I personally like and believe that the most profitable traders are taking 1-to-1 R trades or 1-to-2 R trades, meaning their typical stop loss and their take profit is about going to be generally the same, or their take profit's generally going to be double what their stop loss is, so somewhere around here. Okay? And there's benefits to both, but here's the benefit to the 1-to-1. The benefit to the 1-to-1 R is a 1-to-1 R trade, if I were to short here, is not very difficult, meaning even if I'm wrong, we still could hit the take profit and then go back up because the take profit's so short. So it's actually easier to get a 50% win rate or higher to be profitable taking 1-to-1 than you think, because there's some situations where, again, if I'm taking a short here, okay, let's say I take a short here. Let me log into paper trading real quick. Like, I could be wrong. If I take a short here, I could be wrong, like I said, but my take profit might still hit, and then we might go up after that. So that's the beauty of taking 1R. And with any solid edge strategy, it's very easy to have a higher than a 50% win rate if you use a 1-to-1R kind of method. Now, the downside to that is if your win rate isn't that high and it's like 60%, it's very hard to be profitable with 1-to-1R, okay? Now, I would say if you don't have as much of an edge or if you're not as confident, then 1-to-1R trades are going to work better for you. But if you have a very good edge and your strategy is very good, which it should be by the end of this boot camp, then go for 2-to-1R trades. Here's why. If you're going for 2-to-1R trades, you only need a 40% win rate, which, by the way, the technical term, it's actually a 33% win rate to break even, but it doesn't show that here. You need a 34% or higher win rate to not be red or to be profitable. All right. Now, why is that important? Because if you truly have an edge in this market, and by edge, I mean not buying off EMAs, because that's not an edge, that's just gambling, then you can very easily have a 2R. You can very easily catch 2R trades. You just need to win them more than 34% of the time. And 2R trades are very, very attainable at least 50% of the time. You could have a 50% win rate for a 2R trade and be profitable. Now, here's the thing. A 50% win rate at a 2R is profitable, which means what? Which means you could literally flip a coin, and with any sort of edge, you could be profitable. You could flip a coin. A coin is 50-50. But if you flip a coin and go for 5 2R trades, you could be profitable just flipping a coin because of how risk reward works. And again, let's think about technicality here, right? If I take one contract short, all right, I had to sell one contract. My stop loss here, let's say it's $100, so I lose $100. Now let's say I take the same trade later down the road, same number of contracts, same everything, but let's say it's a win. So let's say this one's a loss, but then let's say this one's a win. I lost $100 here, but then I gained $200 here. So I'm still profitable even after one loss and one win. With a 1-to-1R, if one loss and one won, you'd be a break even again because you lose 100 here and gain 100 here. But if you lose one here, if you lose here, you're losing $100, but you win here, you're gaining $200. And that, my friends, is the power of risk to reward and why risk to reward is so important, because it's very attainable if you do have that edge to win 50% of the time or more at a 2-to-1R if you know what you're doing and you study hard enough. And again, it's very, very attainable. So I would recommend going to this diagram and just type in win rate and risk management, and you can go, there's a bunch more. You can literally look at this, whatever's most easy for you to read. But they're all going to tell you the same thing, all right? And that's so important. So when you're using this tool, okay, the short position tool or the long position tool on TradingView, okay, basically what you're going to want to do is if you want to get in a position, you need to know how much you're willing to risk, okay, whether that be 100, whether that be 200. And the typical risk on people's accounts is 1%. So if I just bring up a calculator, the typical risk people do is 1%. If I bring up a calculator, maybe let's say we're on a $50,000 account and I do times 0.01. So people would typically risk $500 on a $50,000 account. Okay? And that's fine. Now, for a prop firm account, which I already went over, I would actually do less than 1%. I'd probably do 0.5%. So on a $50,000 account, on a prop firm account, I'd probably do times 0.05. Oops, I didn't mean to do that. 50,000 times 0.005 equals 250. So I'd risk $250 per trade on a $50,000 account. So let me just reset this real quick. Okay, let me just type in 50,000. So let's say I'm on a $50,000. It's a prop firm account. It's fake money. This is a challenge we need to pass to get paid real money. And I want to take a trade here. Well, you're going to right click this. You're going to click create limit order. All right. And you're going to type in the risk. And we actually have to do this on the micros because this is going to be too much for this. So same thing on the micros. We're going to put a limit here, stop loss at the high, and go for a 2 to 1R. All right. We're going to right click, create limit order, type in 250 because that's how much we can risk. And it allows us to risk 5 contracts. If I type in 270, it doesn't even bring it up. If I type in 280, it doesn't bring it up. If I type in 290, it does allow us to risk 6. But at 250, the highest amount is going to be 5 contracts. So I just click sell there. And now I have a limit place. Now it has a stop loss. And now it has a take profit. So on a $50,000 account, if you're trading on a prop firm, I think a 0.5% risk is good. And I think a 0.5% risk is good on every account. But basically, if you lose a trade, you're losing 0.5% of your account. Now, if you're on a live personal account, that basically means you could lose a lot of trades. You could lose 50 trades and still not even get close to blowing up your account is what I'm trying to get at here. And basically, you would be risking 0.5% of your account here to make, which is $250 about, in order to make 500. So you could double your money and make 1% off of only risking 0.5%, which is very good. Okay. Now, obviously, the percentages are a little different because as the account goes up, the percentage is going to change, but you guys see what I mean. All right. So that's really important to understand. Why? Because risk management is everything. So all you need to know how to do is click create limit order, type in the risk you want to take, which this risk would be 250. It allows me to take 5 contracts, and that's what I do. I'd sell 5 contracts. Okay. Now, let's say I want to take a long here. Same thing. Let's say I want to take a long. Let's say I think this is a demand zone, even though we don't trade demand zones. And I want to take a long in the demand zone. My stop loss is below the demand. And I'm going to target a 2R right here. Okay, same thing. Right click, create limit order, buy, limit. Okay, remember I taught you guys limited stop orders. And I'm going to do 250, and it allows us to take, again, 5 contracts. So I'm just going to click buy. And now if price comes down and hits my entry, it's going to fill me. It's going to get me in the position. And if it hits here, I'm going to lose $232. But if it hits here, I'm going to gain $464. And remember, if I lost this trade at a 2R, but I won the next trade, you have to understand that I would still be profitable. And you're probably wondering, well, how can you be profitable with a 50% win rate? That's break even technically because the risk reward and where your take profit actually is compared to your stop loss, right? 2R. So if this lost, you'd be losing 1R, and if this won, you'd be gaining 2R. What's the difference? 1R, because 2R minus 1R equals 1R. So that's kind of how risk management works. I strongly recommend using these long and short position tools. You definitely want to be using these. And I think that's about it for this video. Just remember, when you're trading what I teach in the following videos, I definitely change my risk reward a lot. I just don't. If you're literally just strictly going for 2R, that's very difficult because depending on where we are in the market, there's going to be different targets. For example, there's no point in me taking a 2R trade here and holding, like, I do not want to hold past this high, because once you understand that the market should go for stop losses, which means highs and lows, holding for a 2R here is gambling, because you don't know if we're going to go above this high or not. You know we're going to hit the high, right? You know we're going to hit the high, but for all you know, we could go like this. So the biggest thing when you are managing a risk is make sure you are targeting a meaningful high or low. Almost all my targets are highs and lows, with a few exceptions of just targeting for rally gaps only. But 95% of my targets are all highs or lows. Okay, so I always say, like I've been saying, just target 2R, target 2R. You don't want to just target 2R just because it's 2R. You want to target an actual meaningful spot in price where you know the market should hit, or you know the market will be attracted to. Okay, because if you're not doing that, you're going to see a lot of situations where we're going to hit like 1.8R and you're like, come on, go for 2R, but then we're going to dump because, yeah, we hit 8.8R and we hit the first target, but the market doesn't want to go higher than that. It's going to stop out people here and then just shoot down again. So that's the number one non-financial advice tip I have for that. And yeah, again, remember, even if you go for a 3R, like you could go for a 3R here because look, this high lines up here. That means if you win this trade, you could lose the next 3 trades and be break even. So if you win a 3R trade, you could lose the next 3 trades and still be a break even. You could lose the next 2 trades and still be profitable. And the other thing important with risk management is this. If you truly have an edge, do not size up or size down. I have been sizing up and sizing down for the last year only because I've gotten pretty good at knowing when to do that. But when you're starting off, do not size up and do not size down. Why? Well, let's say I want to risk $250 in this position. And let's say it's a loss. Okay, let's say I want to risk $250, it's a loss. And I'm so mad. So then the next position, I'll be like, okay, I lost, I'm ready for the day. I'm only going to risk $150 now. Now, what's the problem with risking $150 on the next position? Well, if I'm risking $150 on the next position, I don't know why it's getting me in there, and that $150 is a win, but you lost to $250 before, you could be red because you didn't size the same. Now, in this example, if you're going for like a 2R and let's do the math here. So let's say you risk $250. Okay, $250 worth of risk. Let's say it stops you out. So now you're down $250. Next trade, I'm going to risk $250 here. Okay, let's say I risk $250 here, or $150 here, and I'm already down $250. Well, you can see if I'm going for a 1.57R and it is a winning play, I'll make $214. So I would have lost $250 and made $214. So even though I lost one and then won the next one at a higher than a 1R, I'm still red because I sized lighter for the next one. But if I size the same and I size $250 for both trades, then look, the next trade I'd be up $374, so I would be green. So when you're starting, I would definitely recommend doing the same position size. And if you guys want to check out FxReplay to get the hang of this, you just type in FxReplay. It's basically backtesting software where you can backtest NQ. If you want a 15% discount code, use code DODGY15. You can use this and it allows you, let me just sign in real quick. It literally allows you to calculate your risk. Okay. So let me just pull this up real quick. And it's really, really nice. So this is the Euro chart. And again, I'm just going to take a trade for just because. So let's take a short here just because I think we're going to dump. Obviously, I don't think that. But again, if I click it, click place order, it'll tell you, okay, how much percent of your account do you want to risk? And let's say 0.5. 0.5 of 12,036 is automatically allowing us to risk $50. So I just click save, and then it gets me in the position. Okay, now let's see what happens. Okay, so that is a loss. Okay, so that's a loss. Now, I just risked 0.5% of the account, and I just lost about $50. Now, what if I go in another short, risk the same amount, or risk the less amount, like 0.30, and risk $30, and what if it's a win? Let's see. Can this be a win? Look, let's see if let's see this. Okay, right there. Look, that was a win, but that really didn't do much because I sized down, and I lost more in the previous position because I was sized up more. But if I size the same on this, I'd overall be green. So do you understand how that works? So that's why sizing is important too. And as a beginner, I definitely size the same for most of your trades. And if you go in and backtest an FxReplay, I just typically do 1% of the account typically for every single play take. And you'll find that if you risk 1% of the account on every play, it'll definitely give you more definitive results than just if you risk 1% versus 0.5 or versus 3%. Once you get really advanced and in a lot of screen time, you can risk different depending on the setup and your confidence, but that's something for down the road. So again, code Dodgy15 if you're interested in that. And I think another thing that backtesting an FxReplay will help you with, even though I don't like backtesting, is it really shows you the power risk reward. And like you could take 3 losing trades or 4 or 5 losing trades, and then 2 winning trades that might be 2 or 3R, such as this, will get you back green. And it's kind of cool just to see the power risk reward when you size the same. So that is it for this video. Let me know if you guys have any questions. I will see you in the next one where the fun stuff starts to begin, and I will see you guys later. Peace.